Welcome to What's Up in Housing for this week. And the topics that we're going to be covering today are mortgage interest rates and what the Fed decided to do last week at their monthly meeting. And we'll also be talking about our local inventory levels and home prices. Our first topic is mortgage rates. And they've been a big story in the housing market for a while now. And it continues to be a big factor with both buyers and sellers. But before I get into where mortgage rates are right now, let's talk about what affects mortgage rates. So this quote from NerdWallet explains what affects mortgage rates really well. And they say that mortgage rates are influenced by many elements, including inflation rate, the pace of job creation, and whether the economy is growing or shrinking. The Federal Reserve's monetary policy is a factor too, and is set by the Federal Open Market Committee, which most people know as the Fed. And they control the federal funds rate, which is different than mortgage rates. However, the federal funds rate, it does influence mortgage rates. So now the Fed met last week and they were trying to decide what they want to do with the federal funds rate. And basically three things can happen. They can increase the federal funds rate, keep it the same, or decrease it. Pretty simple, right? Right now, everyone looking to buy a home is hoping for that decrease. So last week, the Fed met and they made that decision to maintain the Fed rate at 5.25% to 5.5%. Now, we didn't see it get lowered, but one thing that Jerome Powell, he's the Fed chairman, one thing that he said is that they don't expect to be raising the Fed rate in the foreseeable future. So that's really good news. Now, let's move on and talk about what the Federal Reserve looks at to make their decisions so that we can better understand what could happen in the near future. Here's part of the statement from the Federal Reserve, and it reads like this. The committee's assessment will take into account a wide range of information, including readings on the labor market conditions, inflation pressures and inflation expectations, and financial and international developments. Now, they mention international developments, and this is something they can't necessarily control, right? Now, there's a conflict in Israel and the Middle East, and there's the Ukraine war. Now, these two conflicts, they could change the Fed's position if something major happens, but obviously, let's hope not. So let's look at the first two items they mentioned then, labor market conditions and inflation. Let's look at what's happening in the labor market first. So this graph here, it shows that the unemployment rate since August of 2023. And as you can see, unemployment skyrocketed when the pandemic started. And this is one of the main reasons why rates started going down to where we eventually saw them in the low 3s and high 2s. And right now, we're at 3.9% unemployment rate, and the Fed wants to see this at 4%. So 4% is their goal, and we're close. In fact, last week, after the Fed had already had their meeting and they decided to leave their rates alone, the jobs report came out and we saw less jobs created than expected. And forecasters actually expected unemployment rate to be at 3.8%. Instead, we got 3.9%. And those numbers from the jobs report actually made mortgage rates go lower at the end of last week. Now, we don't like seeing anybody lose jobs, but higher unemployment usually means rates are going to likely come down. So as you can see, the Fed rate isn't the only thing that affects mortgage rates. Now, let's look at inflation. This chart shows inflation since January of 2020. Inflation started climbing once the pandemic hit, and it actually got as high as 8.9%. We're now at 3.5%, but just like unemployment numbers, the Fed has a goal that they want to reach, and that goal is 2%. So once inflation gets down towards 2%, we believe the Fed's going to start lowering the Fed rate. Next, let's look at what economists think is going to happen with mortgage interest rates in the future. So Fannie Mae, MBA, and NAR, the National Association of Realtors, are three big players in the industry, and these are their predictions for interest rates from now through the first half of next year. As you can see, they're all fairly similar, so let's take the average of the three, okay? Right now, we're in quarter two of this year, and they expect mortgage rates to get to 6.83%. And in quarter three, they expect it to be at 6.63%. In quarter four, you can see that their expectations start to break through that 6.5% barrier and fall to 6.43%. So next year in quarter one, they expect 6.27 and 6.17 in the second quarter of next year. Obviously, these rates are fairly high when you're looking at it from a perspective of the low threes of the pandemic. And you would think home prices would be plummeting right now, but they're not. And here's why. You've probably been hearing a lot about how inventory is low, and it's true. This graph shows the active listings for each month of April for Los Angeles and Orange counties. As you can see from the left side of the chart, Los Angeles County, the blue line, had almost 20,000 active listings in April of 2019, a year before the pandemic started. But when the pandemic started in April of 2020, there were 3,000 less listings from the year before, and that trend has actually continued into 2024. So this April, we had 11,000 homes on the market, almost half of what we had before the pandemic. And Orange County is even worse. They had 8,500 homes before the pandemic, and now they only have 3,300 homes, and that's less than half. So that lack of inventory is one of the main reasons why homes are still selling quickly and prices are rising despite those high mortgage interest rates. To prove this, let's look at where sales prices are now compared to pre-pandemic prices. And the median sales price in LA County, again the blue line, was $625,000 in April of 2019. And now the median sales price is $900,000. That's an increase of $275,000 or 44%. And for Orange County, prices increased $455,000 or 63%. And so as you can see, there was even a dip in prices last year, which proves another point, especially here in Southern California. If you plan on living in your home for at least 5 years, buying a home is a good investment because even if there is a dip in prices like last year, they will eventually come back over time. And if you'd like to look at the sales price for just this year, you can see that home prices continue to rise since the beginning of the year. Again, this is due to the law of supply and demand. Despite the high interest rates, we just don't have a lot of homes on the market right now. And there are a lot of reasons for this limited supply of homes on the market, like, especially lack of affordability, especially for those younger generations that are just trying to get into their first homes. Also, a lot of homeowners refinanced during the pandemic, and they have interest rates in the low threes or in the threes and fours, and they just don't want to give up those interest rates to move into something different. And also homeowners, they're just staying in their homes longer than they used to. And we actually started seeing this trend before the pandemic started, but I think the pandemic probably made it even worse. So let me leave you with this quote from Bright MLS, and they're one of the largest MLSs in the country. And here's what they say. They say, expect rates to come down in the second half of 2024, but remain above 6% this year. Even a modest drop in rates will bring both more buyers and more sellers into the market. So I believe this is so true. Remember a little bit ago when I mentioned that interest rates fell slightly at the end of last week because of the jobs report that came out? Well, guess what happened to the number of mortgage applications that were submitted after that? They went up. They actually went up. So buyers are reacting as soon as they hear about some good news with interest rates. Remember what happened during the pandemic when interest rates started falling. Everyone started looking for homes, and every seller out there, every homeowner was receiving multiple offers and getting premium prices for their homes. What do you think is going to happen once we get back under 6.5%? Now, I don't think we're going to be in the same situation we had during the pandemic, but I do believe we're going to see a lot more multiple offers and offers getting accepted above asking price again. So whether you're looking to buy or sell in the next year or two, everyone has a unique situation, and you can feel free to reach out to me or my team by commenting on this video, send us a message, or just email me at chris@chriskawasaki.com. And thank you so much for staying to the end of this video. and I hope it really helps you. So please make sure to like this video and press the little subscribe button so we can continue to help guide you home.